to have with us this afternoon Robert Schuster, who is going to be acting as moderator today while Pat Soshik delivers today's presentation. So now I'm going to turn this over to you. Let me actually get the slides up there, and we'll get underway here today.
Thank you, Cynthia, and welcome everybody to the Ned Davis webinar, Social and Distancing, Shifting from COVID-19 Leaders to Laggards. As mentioned, my name is Robert Schuster, Vice President of Product Innovation at Ned Davis Research. Joining me from NDR and providing the insights for this presentation is Pat Josik, NDR's U.S. Sector Strategist. Pat provides NDR clients with insights on U.S. sector and industry leadership trends and themes based on macro, fundamental, valuation, quantitative, and technical analysis. Pat also makes underweight and overweight recommendations on all 11 GICS sectors relative to an S&P 500 benchmark. Given NDR's top-down approach, Pat also works closely with NDR's senior U.S. strategist Ed Clissold to incorporate NDR's overall market views. Today's presentation will focus on evaluating the investment landscape for future stock outperformance in this COVID-19 environment. The discussion will include opportunities and risk in energy, financials, real estate, and discretionary, understanding the impact of social distancing on a stock before you buy it, a framework for thinking about which of the most negatively impacted stocks will be the first to bounce back, and finally, potential winners and losers in industries in this particular environment. Before we get started with our prepared remarks, I'd like to give you a quick overview of Ned Davis Research, also known as NDR. NDR is grounded in using empirically driven, historically tested research to separate fact from fiction, which helps put clients on the right side of major moves, as well as helping them communicate reality to their clients. We believe to have a clear view of the investment landscape, which is never completely possible, one must incorporate a comprehensive approach. NDR's 360-degree approach to market and investment analysis combines 4 disciplines. Technical, it's the key to keeping you on the right side of the move. Sentiment, which we believe gauges supply and demand, as well as fear and greed in the market. Fundamental, which is imperative to understanding the long-term perspective. And finally, macro, which is critical to understanding the regime of the investment environment and its risk and potential. NDR uses this weight of the evidence approach based on empirically testing history to help our clients see the signals and avoid mistakes. NDR was founded in 1980 by Ned Davis. Today, we are widely recognized for our concise commentary and unbiased views. With that being said, let's begin. So Pat, let's start with the macro impact of COVID-19, particularly on employment, and get some numbers and facts around industries that were most and least impacted, as well as some categories of the workforce and who was most impacted by this virus.
Thanks, Robert, and thanks for everybody for joining us today. Yeah, you know, if I had to describe the virus, if I gave it a personality, I'd certainly say that it's not fair and maybe even downright mean, just based on the industries and the people that it's kind of targeted. And if you look at the table on page 1, what I'm looking at here is a breakout of services payrolls. Now, the virus has devastated the service industry. This is where the majority of the job losses are. You can see in the lower right-hand corner where it says minus 16.2. We're looking at the difference between February payrolls and May payrolls. It's declined 16.2 million jobs, and the overall decline has been about 19 million. So you can see this is 84% of the job loss has been in services. And if we break that down even further, you can see the majority has been in leisure and trade, right? The trade categories, mostly retail impacted there. And then the leisure industry, you can see 7 million job losses, loss of jobs in this category. And so this is the area that has really been targeted. It's really been hit. And if you turn to page 2, I'm showing you employment now by education level. The reality is that the leisure and retail services industries are less skilled jobs, meaning that they require less education. So the unemployment has really hit the less educated a lot harder than it has the educated. So again, similar concept. We're looking at the difference between February and May, and we're looking at the unemployment rate by education level. And you can see back in February of 20, if you had less than a high school diploma, your unemployment rate was only 5.7%, and for college grad it was 1.9%. The difference between those two was 3.8%, right? This is almost heartbreaking to me because in September of 2019, this gap between less than high school diploma and college grad was only 2.8%, right? The lowest on record. Now it's jumped up to the highest on record. In April, it was 12.8%, and in May, it only came down to 12.5%. So we've gone from this almost, negligible, narrow gap in unemployment to this record-wide gap in educational differences. So a great disparity here now between the less educated and the more educated in terms of unemployment. And if you turn ahead to page 3, you'll also notice that there's a gender difference and an age difference. And what we're looking at here now is the difference between February and May, the employment population ratio. The employment population ratio is simply the percentage of people in that age group that are employed, okay? And so if the number one category with the biggest decline in the employment population ratio is women aged 16 to 24, you can see 14.1 percentage point decline there, most hardest hit. The second was men in the same category, right, down 13.1%. But then the third hardest hit was women aged 25 to 54, down 9.7 percentage points. And the fact is, women and young are more leveraged to the services industry. And so you start to get the picture of who's really involved here. And I don't have a slide on race, but race is also a factor here, right? If you looked at the May unemployment by race, the white population was 12.4%, African American 16.8%, and Latino 17.6%. So if you look in and you think about some of the protests that's going on, it's certainly about racial inequality. But if you think that there's a part of it that's income inequality as well, I share that opinion. I definitely think there's injustice in the income inequality feeling out there as well.
Great, Pat. So let's transition into the investment landscape. And you've had some pretty consistent themes and conviction around the industries and sectors you thought would be most likely to outperform and underperform in this environment. Can you walk us through your breakdown and rationale?
Absolutely. Let's go ahead and turn ahead to page 4, and we'll take a look at these are industries' year-to-date performance. And we break these down we tend to group them in macro areas because that's how we do this in a top-down environment at Ned Davis. So the red is commodity, the brown CapEx related, the orange is more credit sensitive, and the blue consumer, and the green what we call bond proxy or the high dividend yielding areas. So if you look at the bars to the right, those are the few industries you'll see that are outperforming year to date. And if you read our sector research, you'll notice 3 consistent themes that we talked about. And we've named them COVID staples, consumer staples, and computer staples. And these are themes that we felt could continue to outperform even in the coronavirus environment. And I'll just take each one of those one by one. The COVID staples is really exposure to healthcare and really drug companies. So if you look at the longest blue line in the bottom there, you'll see pharma, biotech, and life sciences. This is one of the few industries with a positive year-to-date return. We like, obviously, there's a lot of excitement around some of the drug companies that can develop a vaccine or treatment for COVID-19, but we like that group even before that because of the good growth that we've seen here and an attractive valuation. In addition, we also like the pharma and biotech because we believe the political risk has really fallen, especially with Joe Biden as a leading presidential candidate. He's much more healthcare friendly than any other candidate we've had. His goal is to expand the Affordable Care Act, and that would really be beneficial for healthcare. So you can, you can try to own some of the high-flying names in the COVID area, like Regeneron and Moderna. But I really think, an equal-weighted biotech index like XBI, the Spider Biotech Index, is great exposure there. Second category, consumer staples. This was really related to the COVID environment. The fact is, people are just not going out as much as they used to, right? They're spending more time at home, and especially with meals. And so they're buying a lot more food at grocery stores, and they are eating at home much more. If you're not going out more, you're eating out less as well. So it's really been a beneficiary. We like the general merchandisers here, the retailers that also sell food. So Walmart, Costco, Target, and I'd even put the dollar stores in that area. So we think that should be a core holding as well. And then last, computer staples, right? It's really strange to me to be saying that tech companies have been defensive, but they absolutely have in this environment. The growth has not only been high, it's been consistent. And here we're kind of talking about the FanMag group, right? So that acronym: Facebook, Amazon, Netflix, Microsoft, Apple, and Google, and plus software in general. And you can see the brown line there for software as one of the best performing industries. And this is the area that we want exposure to. You can own the FanMag names. We think a really good way to just get exposure to FanMag and the software group is to own the NASDAQ 100 group, right? The Qs, the QQQ ETF is a great way to gain exposure there. And really, until we have more clarity on this coronavirus clearing up, this is what I would recommend you need as kind of core holdings.
Fantastic. So that's a really good summary. Go ahead.
Yep. Just one more comment on slide 5, just to emphasize the computer staples category. The green line here is the year-over-year growth of CapEx spending on software. And this has just been incredible to watch. This software category, this is nominal basis, has grown 6% for 16 consecutive quarters. Okay, no other GDP component can claim this type of consistent growth over the last 4 years. You can see the blue line is industrial equipment, and you can see that portion of CapEx has really fallen off. And so I just wanted to highlight that software has been defensive because there's a bigger theme going on here, right? The move to cloud and enterprise software as well as AI has really driven a secular bull here, not seen since the 1990s. So just wanted to emphasize the point here as to how it's possible that a technology area could be considered defensive in this environment.
Thanks, Pat. That's great insight, and that's a good summary of your core recommendations. But what about some of the areas more negatively impacted by the coronavirus? What areas are you focused on? What indicators you're looking at to sort of turn more bullish?
Right. This is what we kind of want to talk about today, right? So we know the leaders are well known, and we want to talk about the laggards and how we're going to get comfortable stepping up to some of these names. And so the first thing I want to point out on page 6 is to take a look at the where the laggards are. And there's a couple ways to look at this, but the way I did it was I just looked at the percentage of stocks in each sector that are in a bear market. And by bear market, I mean they're down more than 20% from their 1-year high. And so you can see almost all energy stocks are in a bear market, financials almost 73%, real estate 71%, and discretionary 65%. So these are the sectors that we want to look at, and we kind of want to drill down into more into the laggards. But this is where they're concentrated. So this is where they are. Let me talk about a little bit more about the signals that we want to look at as to when to buy these names and when we're going to be comfortable to step up to these different areas. And the first thing I want to talk about a little bit about is volatility, because volatility is a good indicator of the safety of when to step into an area, right? Typically the best time to buy after a bear market is when volatility has peaked and it's started to head down. And I think one of the warning signs about these COVID laggards is that the volatility is still extremely high in these names. We have a couple of different ways to measure volatility. On page 7, I'm showing you 100-day volatility. What that is, it's simply the 100-day moving average of the percent change in the industry up or down, right? So it doesn't matter. It's the absolute value. And so, typically in normal environment, you wouldn't see much more than a 1% change. So the fact that some of these sub-industries are moving, 4 or 5% on an average daily basis, this is incredibly high volatility. And so you have to be warned about that volatility. Another thing we can look at for volatility is we can look at for broad volatility in the S&P 500 index. And this is one of my favorite things to look at is the CBOE S&P 500 Volatility Index, also known as the VIX. And so if you look at page 8, I'm looking at the bottom now of page 8. This chart is the VIX, the Volatility Index, and you'll see that black dashed line. At Ned Davis Research, I call it the magical line, but it's 28.5 on the VIX. And when the VIX is above 28.5, we'll just say that we're in the danger zone, right? Volatility is high, and you can still have, real significant declines in this area. And, you can see the great move in the market as volatility reached a peak and came down, and it looked like we were kind of coming into this comfort zone, right? In the first 10 days of July, the VIX was below our 28.5 level. I think it's below 30 for the first 10 days of June. But it doesn't mean we're going to get out of this, without some volatility. And in fact, we saw something very similar in 2008 and 2009. It was a higher level back then, but we saw volatility kick up again before we started the bull market in March of 2009. Certainly, COVID is going to play. It's going to have a say in this, right? There's going to be a correlation between the COVID activity and the volatility in the market. And so just to kind of talk about that, I want to jump ahead to page 10, and I want to look at, we track the COVID statistics as most people do. This is kind of a simple chart, and this is a global chart. The top is just the total estimated active cases. The middle is the recoveries, and the bottom is the one that I really want to focus on, and that's deaths as a percentage of total cases. And I really think that, the volatility in the market will be tied to this death rate, right? If we can come up with a good vaccine, that's certainly going to help reduce the death rate. But even if we just come up with good drugs, right, that can help mitigate the effects of COVID, you're going to see confidence really come back, I think, to the economy and to consumers. We do have some good drugs, right, that are starting to show promise, right? We've got remdesivir, dexamethasone is out there, and plasma therapy. These are three things that are being used right now to really help. And so to the extent that this death rate comes down, I think you're going to see the volatility really start to come down. And so, that's the key, I think, correlation to watch there. All right, let's talk about the different sectors now and how we can, what's going to get us comfortable with these different sectors and to step up to some of the COVID laggards. And, I'm going to talk about just energy for a little bit on page 11. This is a really tough spot for energy because, energy is a global market. And, what we've talked about at Ned Davis Research is that this could just be a really slow economic recovery, right? Everybody has a shape that they want to talk about, but we've talked about a square root shape where you get initial bounce off the bottom and then a kind of slow recovery, or a U-shaped recovery. And the fact is here for energy is that if we don't have a V-shaped recovery, you're not going to see a strong snapback in oil demand, right? It's going to be a slow recovery to oil demand. And if that's the case, then you have to have a sharper decline in the oil supply to offset this slow demand. And we've been so slow to do it. What I want to focus on is in the middle page of 11, you can see that we're almost up to 540 million barrels of oil, of crude oil, in inventory. This is getting back to the record levels. In fact, we're at record levels set back in 2015, 2016. And so we really just very simply need to see inventory cut to get the supply and demand back in balance. So not time to step up yet, but if we can see signs of the supply being cut, we want to come around and look at these energy names a lot closer. All right, let's turn ahead to page 12 and talk about financials. That was the second area that was most beat up. And, I'm not as worried about financials in terms of loan losses. That's, initially why the group had been beat up. Certainly they're going to take the brunt of, some of the COVID businesses that will go under or not be able to pay loans, but they're well capitalized and they'll account for those loan losses. But we just need something to get the banks going here, basically. And so, the two main areas are loan growth and net interest margins, right? So the net interest margin, the banks lend out at the long end and they have to pay, deposits at the short end of the rate. And so we want to see the difference between the long end and the short end really grow. Now, the short end should be well anchored by the Fed. We don't have to worry about that. So we can just watch the long end. And so really, if I say, for banks, if there's one thing, just watch the 10-year yield. The chart on page 12 is showing the blue line is the 10-year treasury yield, and the black line are banks relative to utilities. So banks are the most positive rate sensitive, and utilities most negative rate sensitive. And there's been a really strong correlation between these two, but we really need to see a gap. Right now, that gap is only about 50 basis points difference between the 10-year yield and the 2-year treasury yield. That's the kind of the yield curve that we like to look at for net interest margins. Our research says you really want to get up closer to 100 basis points or at least 60 basis points for sure. So either we need higher rates on the long end, or we need to see loan growth pick up. And right now we have neither of those. We're getting closer on the rates, but right now we have neither. So again, cautious on the financial side. And let's talk about the last two sectors now, because I think those are the most directly impacted by the social distancing. I talk about energy and financials as indirectly impacted, but real estate and the consumer discretionary area are the two most directly impacted areas. On page 13, if you look at the bottom chart, we're simply looking at the lodging occupancy rate, okay, the year-over-year change in the occupancy rate. You can see the huge dramatic drop. It's getting less negative. But we really need to see that bottom out and start to turn positive in a meaningful way, right, before we can get positive on the hotel and resort REITs. You still have to believe that social distancing is going to impact office REITs, right? How many people believe that it's safe to come back to the office? You're in a closed environment. It's just one of the higher risk areas. Same thing with retail REITs, right? To go into malls, you have to have a certain amount of comfort level that the virus is under control. And so, this is a really tough area to get going again. And we're going to need to see, the real comfort level that the virus has dissipated for this area to come back. If you turn into page 14, same kind of case, for discretionary in retail stores. At the top of page 14, what I initially did was I listed the 10 most impacted sub-industries that I thought were directly impacted by social distancing. Office REITs should be on this list as well, so we'd call it 11. But if you look at it, 6 of these are from consumer discretionary categories. So, don't be fooled by that big retailing return that we saw before. That's all Amazon, right? So the retail index is really outperforming on a cap-weighted basis, but the S&P 500 index on an equal-weighted basis is down 10% for the year. And so these are the areas that are directly impacted. And so what we really need to do is just have a comfort level that the coronavirus is more under control before we can get comfortable with that. So that's where we're at, is trying to figure out when is that comfort level going to rise.
Great insights, Pat. So you've highlighted the need for some social and distancing, but we'd like to sort of know when this is going to happen. So we thought we'd try and gain some insights from you, our listeners, and take a poll. And the poll is just asking, when do you anticipate traveling on airlines on a regular basis? 1, sometime this year. 2, sometime next year. 3, after better COVID treatment drugs are available. And 4, after an effective COVID vaccine is available. And 5, I'm already flying on a regular basis. So it'll be interesting just to see where people's sort of sentiment and emotionally sort of stand with taking action and traveling on airlines. And I don't know, Pat, if you can provide any insights on, what's sort of the process and timeline of, when vaccines and drugs sort of can hit the market, based on any past events or anything like that.
Yeah, that's the thing is, I think one of the things that moves the market is when vaccines, get approval and move through the drug process. But you have to know that it's a really long road for approval for those vaccines, right? And we don't even know if the vaccines will be completely effective after they come out. But you have to go through 3 phases of clinical trials. Then you have to have FDA approval. Then you have to, build out the supply of the drug and distribute it. I haven't seen anyone who gave a projection that the vaccine would be available before second half of 2021. And so, I think we have to be of the mindset that this virus is just going to be with us for a while. So, you can see from the poll, right, that 37% say sometime next year. And I'm just wondering if that isn't because most people believe that that's when a vaccine will be available next year. An effective vaccine will be available next year. So, let's hope that that's the case, and let's hope that that will really be the turning point of getting everybody comfortable, getting more back to kind of a normal environment.
Perfect. So, other than looking for a cure or vaccine, as you mentioned, which maybe may not happen for quite some time, what other things are you watching to see if things are getting back to normal?
Yeah, so it's interesting. Every once in a while, I'll see some really sophisticated data that will look at cell phone usage, right? So tracking patterns of people using cell phone data is kind of an indication to get a feel for consumers and they're heading back to more normal activities. But I'm just kind of old school and in free data. I'll talk about a couple of areas that I like. Number one is simply just looking at retail sales, right? I've covered the consumer for 2 decades, and I have a mantra that I say is watch what they do, not what they say, right? So I put much more weight on actual consumer spending numbers and retail sales numbers than I do on consumer sentiment polls. And what I'm showing you on page 15 is a look at the year-over-year change as of May in some of the different retail sales categories. And so, we see the impact still of not driving. I say not driving into the office, right? Gas station gas prices are way down. Auto sales, although they're starting to show some bounce back, are still down year over year. Clothing is probably the most devastated area, right? Certainly don't need to dress up for a Zoom video, and so this has devastated the apparel retailers and the department stores. Not eating out, we talked about it too. Not going to bars. The food services and drinking places and retail sales still down very much year over year, one of the largest declines year over year. But people are eating at home, drinking at home more, and we're starting to see that those categories pick up on the food and beverage side that will be more leveraged to grocery stores. Probably the clear winner out of all of this has been the non-store retailers, right? The e-tailers. And they've seen the biggest increase in year-over-year sales. Clearly, the lowest risk, is to order from home and have it delivered to you as opposed to going out to the store. I even think pharmacies and drugstores, a smaller venue too, will be considered lower risk, and so those should do well. And then one category, that has been interesting to watch, and I think what's happening here is we're seeing a nesting effect, similar to after what we saw after 9/11. We're starting to see building materials and supplies really start to pick up, and so the home improvement effect is in full swing here. So we can watch the growth rate and the bounce back in these certain categories to determine what the consumer is doing. Another way is to just simply look at the stock prices, right? We believe the stock market is a 6-month lead indicator, and so it's going to be discounted into the stock names. And if you turn ahead to page 16, I've kind of got this on the left-hand side is my old world, and on the right-hand side is kind of the new coronavirus world. And what we can do is we can look at stocks that are the laggards on the left-hand side and compare them to the leaders on the right-hand side. So you can see I say not going to the gym, Planet Fitness versus working out at home. You can see Peloton. And what I'm showing you is the year-over-year price changes and the difference of the stocks here. And they're dramatic, right? So I've got, not staying in a hotel, but staying in an RV, not going to Las Vegas, but betting on the market. A lot of talk recently, right, about retail investors getting into the market and spending their checks in the market instead of other areas. You can see also, not going to the theater versus streaming online, and not working in the office versus working from home. You get the idea here. And what we can do here, and what I'd recommend to do, is to just look at some of the laggards relative to the leaders. Okay, so for example, just take a relative strength chart of Planet Fitness relative to Peloton, and look for a breakout. I don't think you have to be a chartered market technician to figure out when it's breaking out, right? But if you did that, you'd see there's a pattern of lower highs, right? So Planet Fitness is still underperforming Peloton. Same thing. Take AMC theaters versus Netflix. Take a look at that chart. It's still trending down on a relative basis. And so it's too early to to really make a definitive call that this is starting to swing around. And if you turn ahead to page 17, we actually, I like to look at a broad index. So not just only individual stocks, but a broad index of laggards relative to leaders. And what we've done here is we've gone through the whole S&P 500, and we broke them out into laggards, leaders, and neutral, right? We used to say winners and losers, but we figured there were no winners in COVID-19. So we're calling them leaders, laggards, and neutral. And what the chart on page 17 is showing you is the laggards relative to the leaders. And you can see, in May, when a lot of the speculative activity was going on, and a lot of people complaining, oh, this is a small retail investor just buying up these names. The fact is that you had a really big discount at the end of April, right? Almost like a 40% discount of the laggards relative to the leaders. And the COVID cases were dropping, right? So you had this perfect environment set up for a nice speculative rally. But lo and behold, the coronavirus cases kick up again, and now it looks like a failed breakout for these laggards. This is the type of volatility that we're in for. But trust me, I would fully expect that if these names get discounted again back to a similar discount to the end of April, early May, and you start to see cases fall again, you're going to see this kind of speculative activity really pick up. Or it could be the beginning of a bull market for the laggards. So this is the type of environment that we're in, and hopefully I've given you some good ideas as to what to watch. All right. Let's go ahead and this is my my last slide here that I'll talk about. We'll go ahead to page 18 and just talk about what I really want to get at here is evaluating a company before you buy it, right? So let's say we've made the commitment. We want we've got a little money that we want to risk. We know it's high volatility, but we want to invest in the area. And what I would really stress to you is thinking about that. All these laggards are not created equal, right? There is a difference. Some of them are higher risk than others, and I'd really like you to know that risk before you buy a name. And we now know a good deal about the virus, right? We're not doing a particularly good job about stopping the virus, but we really know how it's transmitted. Doctors like to talk about the transmission of respiratory droplets. But basically, we know that the main transmission of this coronavirus is breathing somebody else's air, right? I breathe in and breathe out my air, and you breathe in my air and breathe out air. And this is basically how it's transmitted, right? So, we can look at the different factors that increase the risk of breathing somebody else's air, and then we can apply that to the company's venue, right? To see where their venue is, to see what the increased risk is. And so this is what I've made a little checklist here of questions that I want to ask you 6 questions that I think when you're thinking about a company's venue, or maybe you should even just ask yourself these questions before you go to a venue outside your house. All right. Number 1, is it outdoors? Right. We know that when you're outdoors, that's the best ventilation that you're going to get, right? So those droplets can either dissipate or they can be blown away by the wind. So outdoors is way better than indoors. Question number 2, is there good ventilation, right? So we know that those droplets that they talk about can hang in the air for at least 30 minutes with no ventilation. So we want to have good ventilation. So ask your question, is there good ventilation where I'm going? Number 3, are there only a few people around, right? So clearly this is common sense, right? The more people, the more risk. you have of breathing somebody else's air and other people breathing out these droplets. So, are there many people there? Number 4, are they at least 6 feet apart, right? So these droplets kind of hang out by our mouth as they come out. So if you're farther apart than 6 feet, then you reduce your risk of inhaling those droplets. Number 5, are people wearing a mask, right? Very simple. These droplets get blocked. Not all of them, but my understanding is that most of them get blocked by a good mask from coming out. And so certainly wearing a mask reduces your risk. And then last, will it only be for a short period of time? Clearly the more you're around somebody, the longer you're around somebody, the higher the risk, right? So those are 6 questions. If you answer yes to all of those, congratulations, you're in the low risk category. If not, you're in the high risk category. And so, I think of these venues kind of on a venue from, really low risk to high risk. And I was kind of conjuring up in my head, what's really low risk to high risk. On the low risk side, I had this vision of, lonely man hiking in the woods, or maybe just a couple of people outside, windy day, extremely low risk of transmitting the virus, breathing fresh air instead of other people's air. On my extreme other end, the vision that popped into my head was, 20,000 screaming fans. I was thinking, indoor arena with poor ventilation, maybe a Bon Jovi concert, and everybody screaming, living on a prayer at the top of their lungs. That would just be the worst kind of COVID environment that I can think of. But obviously, you get the picture and you understand. And so what I did on page 18 was try to map out, the upper left-hand quadrant, right? Outdoor, great ventilation, right? Few people, distance, and then the lower right-hand corner, indoor, many people close together. And so, the bottom line of this is that, the areas that really strike me as going to have a tough time of coming back are, offices, right? So office REITs, people coming back into the office, because, you're working so closely with these people. And it's often several people in an office. So it's just going to be higher risk. Airplanes, right? Very closed environment. People can wear masks, which is good. And I'm not an expert on the filtering systems in airplanes, and I understand that it's a mixture of outside air and inside air, and that there are filters. But I just think that it's going to be really hard for people to get comfortable with being in a small space like that. If you've ever been on a plane recently and somebody sneezes, everybody panics. And then just indoor entertainment in general is going to have a really tough time, right? Those big venues that are indoors with lots of people are going to have a really tough time coming back, until there's a really strong comfort level. So, again, restaurants that have only indoor venues, that are larger, tough time. Office REITs, tough time. Retail REITs, tough time. And indoor entertainment, those industries, are much higher risk. And so, you really want to think about before you buy the risk. So, let's wrap it up here. I'll go ahead and turn ahead to page 19, just to kind of summarize what we talked about, right? We talked about the risk areas, the laggards areas are in energy, financials, real estate, and discretionary. And what are the things that we need to get comfortable there, right? Lower oil inventories, higher interest rates, and really just some comfort on the social distancing aspect of for real estate and discretionary. Really want to emphasize, and the point of this is understand the social distancing impact before you buy, right? There are venues that are better, that could bounce back sooner rather than those that are more at risk. And again, the more at risk, indoor, lots of people, close quarters. The favorite industries, we talked about the DIY effect and home related, certainly a favorite area. We talked about e-commerce, certainly a winner. And recreational, I didn't talk a lot about that, but that's something that you do outdoors that certainly certainly will benefit and work in this COVID environment. Like we talked about, again, the least favorite, office REITs, hotel REITs, retail REITs, airlines, and just any large crowd indoor entertainment. So I think I will leave it at that. And should we, Robert, you want to open it up for Q&A?
Yeah, no, thank you very much. Great discussion. I think there's a lot of good concepts here that people can take away. We wanted to just open it up for some questions that you may have as well. One thing on the, so that last slide, I found the, continuum chart sort of interesting, and there's potential recreational theme in certain quadrants. Do you have any names in particular that you're looking at there?
Yeah, there's a wide range of stuff, if you think about just outdoors. And I don't know if we can pull up chart SIX 25507F, but what you'll see is, it was interesting in April, I didn't really see the rebound in recreational and sporting goods that I thought I would in terms of retail sales. But the chart that we have pulled up now, if you look at the bottom red line, this is sporting goods and hobby as a percent of total retail sales. And so it's kind of the market share. And, this has been in a long decline over this expansion. But this is an area I think, while we're worried about COVID, is really going to work. I already mentioned from, the RVs, I showed on the prior page that, Thor Industries and Winnebago's that creates recreational vehicles. You've seen the rebound in those stocks. There's also, Brunswick and Johnson Outdoors are names that, that do marine, do boat, the water-related industry. That should do well. And even, Dick's Sporting Goods and Hibbett, the retailers in recreation should do well. And some of these names have had good bounces, but if the virus is going to hang around as long as I think it's going to, I think that these names could just be getting going and could have at least another a good year of performance. And so it's certainly an area that I like, and we'll continue to watch the retail sales there.
Nice. Also a question about, do you have any names you like in the home-related sector?
Yeah, so, we have liked housing even before kind of this nesting effect happened with COVID-19. We liked the demographics there. And the demographic story is just that, the average age of the first-time home buyer is around 32 years of age. And that demographic is really going to grow because millennials are really starting to come into their mid-30s. And so I really think there's a demographic tailwind there. You add on to that, like I talk about the nesting effect, and you really have a powerful move there for kind of the home-related names. Now, I think to get exposure to home builders and home improvement, you want to own a basket of stocks. I think ITB, it's an ETF, home-related ETF. I think that will give you the good exposure that you want to kind of play the home-related industry there.
Question came in just about Amazon. Obviously, this is a leader, but what's your view about the valuation of the stock? Can you comment?
Yeah, I haven't looked at the Amazon specifically, but I have been watching as a group, right? The Fan Mag group, and one of the things I've noticed, and one of the things I try to take into account, is not just the valuation itself, but the valuation relative to its market share. Okay, so we have looked at the percentage of earnings for the group relative to its market cap, the percentage of earnings in the S&P 500 relative to its market cap in the S&P 500. And what I would say, first of all, is that some of the recent move that you've seen in Amazon in the group is justified because its market cap and its relative earnings have gone up. But there is a point where it gets a little bit maxed out, and we saw this in 2018, where I think that the earnings, the market cap, even relative to the earnings, was too high, and so we're starting to come up on that valuation level again. So I'm a little bit nervous for the group. But again, I wouldn't sell. I would at least keep a market weight in Amazon and in the Fan Mag group because they continue to gain share, right? And this could be a really slow recovering expansion. And so we want to keep the winners. We don't want to get rid of them. So on the margin, the valuation does look high, starting to get back to 2018 levels that made me nervous. But I think you still got to maintain at least a market weighting in that area.
Great. Question from Henry: will home office growth drive stocks like staples?
It's a good question. From the data that I have looked at, and just kind of anecdotally, one of the things we thought we would see is a really big pickup in printers, right? That we would see HP printers really take off and pick up. And I think there was some disappointing data there, and that we haven't seen it pick up as much as we thought it would. And so, I don't know that people don't have the necessary tools at home that they really need to go out and buy something, right? So, I mean, the main staples at home are, your Zoom video conference call, your whatever your video software is that you want to use. You have to have high-speed internet. You have to have a good phone system, and a lot of the other office stuff can be either brought from the office or you have laying around the home. And so I'm kind of skeptical that the home is that different from the office in that it's going to really drive new and higher product use there. So I'd be kind of skeptical maybe getting at the office retailers. I'd be kind of skeptical that there's going to be a huge wave of purchases there just because we're working from home instead of the office.
Oh, thank you. An interesting question. I'm not sure if you'll have an answer for it or not because it's a little specific, but the question is, what's a great plexiglass play? Lots of plexi out there in the reopening.
That is a good question. Yeah, certainly from our macro perspective where we analyze top down, I'm not in the weeds that too much, but I will take that question down and I will get back to that caller who asked.
That sounds perfect. Well, at this point, I would like to wrap up the presentation. I just wanted to thank everybody again for joining us, and I wanted to really thank Pat for taking the time to provide great insights and ideas that we can all just investigate further. Just remind everybody that you will receive an email with instructions for the replay of this call. So from Ned Davis Research, we all want to thank you and have a fantastic day.